Hello and welcome back to Music Fastball. On this episode, we are talking about the financial pillar of our maturity curve. And we've got two guests with great experience to help us understand how maturity in the financial operations of really any business, but very specifically music catalog operations, can help drive two key important things. And the first one that everybody's talking about is achieving a lower cost of capital. And the second one that everybody's talking about is trying to expand the multiple. So exit on a higher multiple than you acquired any asset. We have Firdaus Dawood, who's got 10 years of experience in institutional capital and most recently 4 years at BlackRock in private credit. And we've got George Williams, who has 10 years of experience in mid-market private equity and 4 or 5 years of experience in-house doing M&A. So very experienced, know both ends of the spectrum, knows what it takes to achieve both of those things. And hopefully we're going to get into some of that detail today. So Firdaus, I think let's try and set the scene first of all. When we talk about lowering the cost of capital, what do we actually mean and how does that differ between debt and equity?
So I think in a, very literal sense, it's your cost of capital is just the price you're paying to access capital, right? Whether that's debt or equity. But I also think it's essentially a confidence tax, right? So the more opaque your cash flows are, the less predictable the business, the more uncertain the future looks, the higher the return a lender or an investor is going to require to compensate for that. And of course, as you've touched on in the podcast, things like operational maturity and reporting quality, those things can directly lower that perception of risk, which then allows you to access better price capital ultimately. In debt, and I think in private credit in particular, that would normally get priced into your spread. I think what's actually interesting on the private credit side right now is that spread compression over the last couple of years has kind of broken that relationship. I think it's worth flagging because music is a similarly long duration illiquid asset class. And so you're kind of looking at potentially a similar landscape. PIMCO actually published a piece recently that was talking about how spreads between direct lending and public credit have compressed to the point where you are seeing investors not adequately compensated for the illiquidity that they're taking on in private credit. And so the all-in cost of debt or cost of capital for borrowers is getting cheaper. But it's not because the underlying credits have gotten better or reporting infrastructure is better, which is what you would want to see. It's because too much capital has flowed into the space and is chasing too few good deals. And you can kind of see that parallel potentially happen one day in music. And so it's a good learning point, I think. You're seeing lenders just getting compensated less for the same or greater amount of risk.
Yeah, and I think that's really interesting. I mean, and that's a very kind of traditional basic market dynamic of supply and demand, isn't it? You know, when you've got an influx of supply and potentially it's outstripping demand, then invariably the the y- the cost is going to go down, the scarcity is going to go down. So actually, that makes total sense. But I think until that happens in the music industry, until we get there, I would expect that there's a significant amount of effort around maturity that has to be put in place, and that comes from operational maturity. So people proving out that they actually can manage funds of that size in a given asset class, and that's what gives people the confidence to introduce more liquidity, and that then has a net impact of obviously increasing supply and therefore reducing the cost. Can you just talk us through the mechanics about visibility and confidence? I think those two things are really, really critical, and invariably, we can't predict the future. So we have to look some way into the past or get confidence as to how and why we should underwrite something or lend at a particular value.
Yeah, I think that trust in a lending context is more or less just another word for your information quality, right? As you mentioned before, in public markets, that's very easy. You have Moody's or S&P or the ratings agencies that are kind of doing that translation for you. of sort of the confidence level into an actual rating number. But in places like middle market direct lending or in music, the risk rating is almost always an internal one that the lending team assigns themselves based entirely on what they see in their analysis. And so poor visibility or poor reporting means the lender has to assume a lot more uncertainty, which will then push your rating towards the riskier end of the scale. And a riskier rating is going to then translate into a wider spread, right? The less visibility that a lender has into a business, the higher that number and the more expensive your capital is going to be. Um, what makes, again, kind of middle market direct lending a good map over to music is that the majority of these borrowers are unrated at close. So the lender is underwriting the credit entirely on the basis of their own internal analysis, and that internal assessment isn't going to be stress tested until maybe way after the deal has closed. And that's not so different from how music debt financing works.
There's always that competitive tension, isn't there? If you're looking at a market which isn't necessarily arbitrated by a third party, then the only point of comparison you have is other people in the market. So by default, you start to draw comparisons. Okay, out of these who we're going to lend money to, which of them do we have the most confidence in? And that then starts to set the standard. And when somebody sets the standard, people start to follow. That leads to norms, and it gives, greater trust, greater inflow of capital. Like, you must have seen that so many different times. Have you got any specific examples or industry verticals where you've really seen that change happen?
I would say you could kind of see the dichotomy happen in private credit. So software is, I think, a good space to talk about this in, especially because software is such a big topic for people right now. But particularly in kind of the 2023, 2024 vintage of deals, the share of software loans at that point in BDC portfolios had more than doubled in a decade. And you could have two businesses in the same subsector that look almost identical on paper, similar ARR, net revenue retention, leverage multiples, but the financial infrastructure and kind of the qualitative story behind those numbers just completely different. And I think a actually kind of good parallel to music in that space is vertical SaaS companies, because you have this recurring revenue that is really the entire thesis. And one company could have a very proper CFO who'd been through a full audit cycle, very experienced. You've got clean data, clean monthly management accounts that can actually be reconciled to bank statements. You've got a very coherent data set, right? The other is maybe founder led. They're running on Excel spreadsheets, a patchwork of systems. Their financial statements are maybe prepared by an outside accountant that has touched the books maybe quarterly, and an ARR schedule that's just never been independently tested. So you're kind of functioning in this place of low visibility and low trust. Both of those companies might get to term sheet phase, but on the well-run company, the gap between what you know as a lender and what's actually happening inside the business is very narrow. Your reporting is very transparent, it's timely, it's easy to verify. On the other end of the spectrum, that gap is very wide for the other company. That wide information asymmetry is going to get priced in two ways. You see it in the spread, and the price, the cost of capital, but then you also see it in the optionality that company has over the life of the deal. So the well-run company can go back to the market many times. They can get an incremental facility. They can get an amendment on reasonable terms, because lenders are comfortable with what they can see. The other company is going to face a lot more friction in any future financing conversation because that trust deficit just kind of accumulates.
And I mean, this is all really just talking about the unknown, isn't it? And how comfortable we can get with the unknown. I think what I was doing some research around this episode and trying to, have a think about how we think about the unknown. And interestingly, the ancient Greeks used to talk about walking backwards into the future. So we can look into the past with absolute clarity, but the future is totally unknown. So it's as if we're using the past to help guide us as to what the future might look like, but it is unknown, and therefore we're ultimately walking backwards into it. And I think that actually plays so well into what we're talking about here, isn't it? It's okay, we all know that we can't predict the future. That's just an impossibility, but we certainly can draw signals and confidence from the past. Now, you could argue there's some danger in doing that as well, but it's really the only tangible thing that we actually can hold on to. So we are humans, we're going to hold on to it, and making sure that you can show that the past is as clear, transparent, and repeatable as possible is going to send the signals out to the people who are going to loan the capital, right? Let's talk a little bit about the implications of this. Obviously, notionally, everybody wants a lower cost of capital, but like, what does that actually mean in terms of going and raising the money and indeed the impact downstream? So, what are you going to benefit from it, and what would that mean in like real returns over, say, a 5 or 7 year period that you're going to invest it in?
So the way I think about it is kind of in two different ways, but it's what that debt is actually unlocking for you. So what does it give you the capacity to do, including building more trust and visibility, but also what it costs to get it. And so to your point, the spread difference between a platform with strong operational and reporting infrastructure and one without, in terms of a spread up front, could be 150 to 200 basis points, maybe more, um, on you know $500 million. That's potentially 10 million a year in additional financing costs that's flowing away from your equity return. But the spread, I think, is only part of the story. Without that operational transparency and infrastructure in place to support a rating agency process, you're also locked out of the rated ABS market entirely, which means that you can't reach investors with investment grade mandates who represent some of the deepest and kind of most patient pools of capital in the space. And so that having strong operational and reporting infrastructure makes a big difference, um, not just in spread, which could cost you, on $500 million, maybe 50 to 70 million over a 5 to 7 year period. But you're also looking at being locked out of other markets where you could get long, deep capital. Um,
So it's not only just like a physical monetary cost that you have to burden yourselves with as you go, but also there's a huge opportunity cost because, if you just don't have the rigor, then you don't get access to these other types of vehicles, which are proxies for very, very large sums of invested capital that typically have significantly longer life cycles.
yes, definitely. And I think it's very high on people's agendas because of what that capital enables, right? If you have the ability to access those types of markets, even if you look at Concord, they were able to do 1.8 billion in 2022 in an ABS, and then they used that to acquire Round Hill. Then they came back for another 850 million in 2024, another 1.7 billion in 2025. And every time they go to market, they're using the strength of everything they've built before that, their existing catalog, the quality of their reporting infrastructure to unlock that next wave of acquisitions. And so that debt is the mechanism that lets you stay in the market continuously and also move at a speed that this opportunity, particularly in music, demands, rather than, maybe waiting around for your next equity raise while someone else is buying the catalog you wanted. So yeah, I think that's the reason why people think it's very high on people's list of things to think about and a big priority.
Yeah, and look, I think it makes total sense. And almost everybody that we speak to who's out there doing it, this is number one priority is okay, what do we need to do to invest into our operations to actually be able to go and achieve a lower cost of capital and to be able to do that just more easily? Greater liquidity, greater optionality makes total sense. Now, George, on the flip side, the other thing that everybody talks about is multiple expansion. So, how are we going to invest in operational excellence that will allow us to buy catalogs at one multiple, combine them up, and sell them at another? Yeah, I think this is a relatively well trodden path in PE, particularly mid market PE. Can you just explain a little bit? When we talk about PE, one of the big metrics that we look at is EBITDA. But as Firdaus explained, those two things aren't always equal. If you've got a SaaS company or two SaaS companies doing the same ARR, they don't actually necessarily warrant the same valuation. And it's the same in the PE world, isn't it? If you've got a company doing a certain EBITDA, and another one very similar, actually what it comes down to is judging their operations, how cleanly they're run, how much transparency you've got. Can you just talk us through that and the implications of it in the PE world and how that might translate to the music funds?
Yeah, I mean, I think it's all to do with, I think it's Firdaus explained really, it's confidence. So a lot of it is about quality that impacts the multiple. So quality of earnings is something that we've talked about, that sort of visibility, repeatability, contractability of those revenues going forward. Because that gives you a sort of underlying stability of cash flows, and certainly allows you to then service your debt with confidence. That allows you to leverage an asset a bit more, which means you put less equity in, you grow your business, and get a better equity return in the end. So I think quality of earnings is a really significant point. But then you've got, certainly the mid-market PE element, you've then got a number of other sort of more subjective factors, I would say, in particular things like looking at the quality and experience of the management team, looking at the rest of the market and how you sit against the rest of the market. There'll be other things like, the technology, the quality of the reporting. All of these things sort of give a sort of perception of quality, which ultimately goes to the multiple. Now it's curious. You sort of look at sort of emerging markets where institutional investors are coming into for the first time. And those guys are sort of going in, they'll find the best assets, they'll pick those off, usually at a sensible price. That drives more investment into the market, pushes the prices up. But then it also has the corresponding effect of sort of improving. People realize they need to improve the assets in the market in order to get the best price. And it also drives investment in those assets. So you start getting things like folks like investment bankers coming in, advising businesses, saying, right, you need to get your KPIs to this sort of level to achieve the sorts of multiples that you want to achieve. So it becomes this sort of snowball effect, a bit of a self-fulfilling prophecy, if you like, as people start investing in a particular sector. And that's the maturity happening.
Absolutely. And, you start to see richer ecosystems of service providers, greater sharing of information between the incumbents, obviously new incumbents because they hear and see about it in the press and more capital's deployed. So it does become self-fulfilling. And I think actually in the early days is making sure that nobody trips themselves up and creates any bad press, which would put fear into prospective investors and things like that. So
Yeah.
actually seeing the market rise as a whole is just really important, isn't it?
And I think also, I mean, that multiple, a lot of PE is about multiple arbitrage. Certainly it's about EBITDA growth. That's the sort of underlying thing that you have to achieve along the way, but improving that perception of quality. And a lot of that comes out of, how can you slice and dice the information, to demonstrate that the business is better quality, that you have better control of it. You can make quicker, more informed decisions. All of that leads to that shift in the multiple over time. And the multiple arbitrage is really where private equity makes its super returns.
Yeah. And that is really significantly important as well. If you take the traditional buy and build approach where you have a platform business and you go and do a bunch of acquisitions and you integrate them into the main business, actually the importance of having repeatable processes, systems, and good clarity and definitions is so key, because otherwise you just end up with a sprawling mess that is quite unwieldy, very, very difficult to report on, doesn't give you a great deal of clarity about where you're going. And there's so many parallels in music rights investing in that the vast majority of the catalogs are small and therefore need to be brought in, aggregated together, and compiled into an operating platform, which is not only fit for kind of purpose today, but also fit for scale into the future. And that quite quickly becomes the thing which helps differentiate the multiple that you pay for a smaller catalog versus the multiple you might pay for a well-preened portfolio of catalogs that have been kind of through the mail and they've been tidied up and they have the visibility and analytical process around that to be able to say, okay, well, we can now trade this on if required.
Definitely. I mean, you would pay a premium for well-established, scalable systems, controls, and processes. I mean, that's sort of inherent, sort of fundamental truth, I think. And from there, you're quite right. You can go out, you pay a premium for your platform acquisition, then you pay, lower multiples for these sort of bolt-ons, if you like, which might be smaller catalogs of music, but you bring them into the platform. So as a result, your blended entry multiple from your platform and all the acquisitions you've made sort of comes down as you buy more and more bolt-ons. But at the same time, as you integrate those, you're bringing them into the sort of quality of the initial platform. You're building scale, and then you've created, an asset that didn't exist in the market before, and that's where you can generate some really strong returns, because as your blended entry multiple comes down by buying all these smaller fragmented books of business, when you exit, you will achieve, hopefully a very significant multiple.
And I think that that's really important too, right? In that, if you look at doing each of the individual deals, whether it be in mid-market PE or whether it be acquiring a new catalog in music, actually the size, there is a relationship between complexity and size, or at least funds deployed, but there's also a lower limit, isn't there? So if you're looking at the larger institutional capital providers, they'll be wanting to deploy several billion, if not hundreds of billions of dollars, and they'll see any either acquisition or deployment with effectively, roughly the same amount of effort, because it's the same teams, it's the same process, they have to go through the same rigor. So it just makes much, much better sense for them to work on significantly larger deals. And therefore it creates some space beneath them in the ecosystem to say, well, hey, if we can go and do these smaller deals at a lower effort, a lower cost of overhead in actually doing the deals, and then building up the portfolio and getting them ready for those big guys who want to deploy the really significant amounts of capital, that can be very attractive, can't it? And in fact, by
Absolutely.
doing that, it creates value for the institutional guys who've got, mountains of cash to go and deploy.
Yeah, absolutely. I mean, you see it in all sorts of other markets. I mean, if you look at the UK sort of private equity market over the past 10 years, these sorts of mini consolidations have been happening prolifically. I mean, the insurance broking sector, IFA and wealth management, accountancy practices, vets, dentists, all of these industries have been consolidated by sort of lower mid-market private equity funds. They've got out and done their buy and build. They sell them onto mid-market funds. They do the same, and then they sell them onto the large cap funds or put them on the public markets. So it's a well-trodden path, certainly, and I think the music catalog sector is ripe for that kind of maturity over the next sort of 5 to 10 years.
Fantastic. So I mean, I think it's really clear that actually investing in those processes, investing in what we would call financial maturity, so reporting, transparency, and everything else, visibility, making sure that you have a good track record, a good history, a good audit trail, not only is going to help you achieve a lower cost of capital, it's going to give you greater optionality to go and raise capital from all of the various different avenues. And also, it's going to help you to build out that platform, which should you then be able to show, okay, well, we've acquired these at this multiple. We've really invested significantly in the operation, and we're now worth X instead. I mean, it feels like an absolute no-brainer to be doing these things. Firdaus, George, that was a great conversation. Thank you so much for your professional insight and sharing that with our listeners. Everybody, thank you for tuning into this episode of Music Fastball, and we'll see you soon.
Thank you very much.
Thanks, Tom.